Welcome to the show. You're listening to The Ecosystem, where we talk with the world's most exceptional entrepreneurs, investors, and emerging growth companies. We're all making a difference in the world. The purpose is to be educated, spark a thought, and understand how the ecosystem all work together. All of this brought to you by the team at Fund. This is your host, RJ Pajaro. My guest today is Vic Pascucci. He is a native of Cleveland, Ohio, and began his professional career in Chicago in 1994. Vic has over 17 years of experience in venture capital, fintech investing, and financial services. He's been a part of over $650 million in venture capital and M&A transactions. Vic has taken multiple companies public and through successful acquisitions. Notable investments Vic has made include Coinbase, MX, Personal Capital, TrueCar, Care.com, ClearCover, and Extend. Prior to Lightbank, Vic built and managed USAA's $330 million corporate venture capital program, where he led investments in fintech, insurtech, banking, investment management, consumer internet, and enterprise and digital capabilities technologies. He also previously had responsibility for the company's M&A, joint ventures, and intellectual property transactions. Most recently, Vic was also a partner with Munich Re, HSB Ventures, where he led their investment activities in insurtech. For more information, check out fundecosystem.com. Now let's give it up for Vic Pascucci. All right. Well, welcome, Vic. Thank you so much for being a part of this. I think it's very interesting. You've been very active here in the Chicagoland space, but not just Chicago, all over the United States. So welcome. And I'd love to know just a little bit more about your background in the space and for the audience.
All right. So first, thanks for having me, RJ. I really appreciate it. Love what you guys are doing with the conference. Love what you're doing with the community. So I appreciate the opportunity to be here and spend some time with the community you're building around here. So my background, of all things, starts as a trial lawyer. So this is back in the mid-90s, I'm a trial lawyer going to court every day, tearing things down and wreaking havoc of things. And I'm going to networking events at night, and I'm meeting all these brilliant people that are super excited about what they're doing, and they're actually building while I'm tearing down. And so I think I have my first midlife existential crisis in my mid-20s going, how do I want to spend my life? Screaming, yelling, destroying, or building? So from that standpoint, I thought the best way for me to get from where I was to into that technology industry where all these people were that were happy building things, technologists, venture capitalists, the only way to do it was to start my own law firm that served entrepreneurs and investors. So I started my own law firm with no clients, no business, not really knowing the sector, and built that up to a law firm that eventually kept 5 people busy, focusing on serving technologists, entrepreneurs, and investors in those businesses.
Awesome. Yeah. So we're seeing more and more lawyers that are doing this.
Yeah.
They're recovering lawyers, I think is what they're called, right?
Right.
And going into both entrepreneurship and VC. Did you practice anything in particular?
I started out early on as an insurance lawyer, transitioned to more of the technical and corporate side of things. And what really got me into venture and got me into the technology sector was there was a guy here in town who I spent, a year and a half trying to get his business from, who finally said, Vic, you'll never get my business, but I will have you as my first general counsel. So I ended up...
That's a win.
Yeah. So that got me out of practicing law and kind of into the belly of the beast of raising capital, building companies. So I was one of the early employees at a local software company here in Chicago. And that company got eventually bought by a company in all places of San Antonio, Texas. Went down there, packaged that company up, sold it off, where I got a call from a company, USAA, to initially be their lawyer for the CIO, CTO, CISO, and head of business operations. And when I was there, it was my first time in these big mammoth organizations. I just saw this immense opportunity to actually do venture just differently. They were buying software, early adopters for new technologies. And so in my mind, that was a portfolio waiting to happen. Yeah. And so I aggravated, instigated, and got them into doing venture. And I built that up from what was, bad one-off deals into an amazing $330 million fund.
That's pretty incredible. So USAA Venture Fund, is that?
Yeah.
Okay.
So it was a off-balance sheet venture fund. And like I said, started off as one-offs and built into a large successful fund.
Incredible. Yeah. Well, I'd love to know more about the corporate VC fund too. Maybe we can get into that a little bit later. So you're a transplant to Chicago. Is that correct?
Yeah.
Okay.
Kind of. So I started out my career, so born and raised in the Midwest, college law school in the Midwest. First job out of school was here. So I was here for about 10 or 12 years, Texas for about 10, 12 years, and then on the West Coast in California and San Francisco area for about a couple of years as well. So it's interesting to see. One, it's great to be back here, be back in this community. It's interesting to see things come full circle too.
Yeah. A lot of those markets, a lot is happening right now. Obviously, a lot's been happening in the Valley. Lots happening in Texas. Austin's one of our markets. It's booming. What do you think about the Chicago ecosystem?
I think this ecosystem and this culture is clearly, I'm horribly biased, but is by far the best. The concepts of culture and community in this city is like nothing else I've ever seen. I've been investing in both coasts as well as between the coasts since 2005 or 6, give or take. And I've seen the transitions of things, but what we have here now in Chicago is just an amazing sense of, like I said, culture and community. People love their companies, they stick with their companies, and they're out to make a difference and build amazing things. The stats are clear now with what we're seeing in Chicago. It's got the highest multiple invested capital of any geography that's out there. If you're an investor, you can't ask for much more than that, right? It's your job to generate returns in this town, in this area, returns like nothing else.
It's pretty incredible. What you mentioned culture. What specifically do you mean by that culture? Here in Chicago and the Midwest, I'm assuming.
Yeah. So for the broader Midwest and for Chicago in particular, people stick by their companies. When I was in the West Coast, as living there and now as an investor there as well, and then seeing the transition of things, like the average tenure of a technology executive or even an engineer in a company on the West Coast is about 14 months. Here we're seeing things 3, 4, 5, 6, 7 years. People stick with their companies. So, that to me speaks to the culture and the community and the types of leaders we have here. Like, people will stick with their companies because if there's anything both of us have learned throughout this business, nothing's ever up and to the right. It's a jagged, wicked sawtooth, right? And there's ups and there's downs, and you got to stick through those downs. And so if you're flipping your workforce every year, how do you really build a culture? How do you really create value? How do you really get the most out of your company? If you've got, everyone switching in and out every year or plus, by the time you bring them in, indoctrinate them, train them up, they're already looking.
Very interesting. Why do you think they're flipping every? That's got to be catastrophic for a small business, right? Like to lose that the tenure and talent that they've just been able to acquire, right? Why do you think they're flipping so often?
I think people in the Midwest, people here find a lot more meaning in what they do and identify a lot with their companies. They're just not looking for the bigger, better deal. They're not flipping across the street because, so-and-so has the, better flavor of kombucha on tap. And so that's their definition of culture. That's not culture, right? And so our people, we stick with their companies, we build them, and we have great exits.
Love it. So you talk about talent, tenure. What else? I know you're a big Chicago Midwest ecosystem guy. What else about the Midwest do you love about investing here?
Well, we also have a bunch of great civic and public-private efforts going on here. We've got P33, which was initiated by Penny Pritzker with the sole cause or the sole responsibility over the next 3 years to raise Chicago's image and raise Chicago's level of essentially publicity throughout the world as a tech hub. And it's not that they have to create the facts. The facts are here. We just needed one organization and one leader with Brad Henderson to get out there and champion that cause and get people indoctrinated, if you will, to what we've got here with workforce, with talent, with universities. And so you've got things like P33. You've also got Discovery Partners Institute, which is going to be like a $500 million effort down in Hyde Park, responsible for commercializing things from our great universities. And then in the advanced sciences, you've got what Argonne and Fermi are doing with quantum computing and everything that's coming out of those labs as well. So we've got great efforts. We've got 1871 as well, one of the most successful incubators and accelerators in the country. So you've got entrepreneurs, you've got great civic organizations, great public-private partnerships as well that are just bolstering this community and taking it to new heights.
Yeah, it's amazing because 10 years ago this stuff didn't exist.
Right.
A lot of everything that you just named did not exist 10 years ago.
Right. So play the tape back to the late 90s when I was here, early 2000s when you had literally nothing that was here. You had Divine Under Ventures, which was a complete disaster, went public on some crazy internet zabatsu business model, which quickly imploded. We had March 1st, that was going to be a web design company of some sorts that was hiring thousands of consultants a month, which did the same thing and imploded. And that was it. And so to come back now and see everything that you've got here, whether from all the great public companies, all the great private companies, it's just an amazing environment.
Yeah, the ecosystem is flourished at this point here.
Right.
Not just here, I mean, everywhere. There's tons of entrepreneurial support organizations out there. So being a Bay guy or, having some of your roots in the Bay, do you think that we will ever be a Bay Area? Are we trying to be a Bay Area? Should we stick away from that? Are we our own? What are your thoughts on that?
Yeah. I don't want to be the Bay Area. We aren't the Bay Area, and we've got so many other strengths. So I think you just have to look at it just historically. Like San Francisco's been doing their thing within technology since the 50s and 60s. There's really no way you can catch up to somebody that's got, or an area that's got 4 or 5 decades of time on you. However, you can look at yourself, you can look at your resources and be the best version of your city or your area or your geography. And it doesn't matter if it's Kansas City, Chicago, Cleveland, Austin. You just have to leverage what you've got and quit doing the comparisons. It's all about who you are and what you've got to leverage. So I don't bash San Francisco. Well, yes, I do. But, there's great entrepreneurs there. I have great portfolio companies there as well. But I just love what we've got as a culture, as a community that's here. So by leveraging our universities, the great engineering talent that's coming out of there, our great public technology companies, Grubhub, Groupon, and those types of companies that are coming up, as well as these great private companies. So it's all here. We've also got a thriving early stage venture community here as well. That's fostering growth, helping companies get created and furthering our success.
Yeah, no, I think that's really interesting because a lot of early stage companies think I'm going to pack up and move to the Bay and go get my funding there, right? Again, being a big Chicago Midwest ecosystem guy, do you think Chicago's the next hub, or are we our own hub at this point?
I think we're our own hub in our own way. And for companies that think they have to move anywhere, you don't, right? If you're a great company, you'll be able to raise early stage capital here in Chicago because we have so many great early stage venture funds that are here. If you execute as an early stage company, the later stage funding will come to you. You don't have to go to it. Build a great company, knock it out of the park on your fundamentals, build a great culture, and later stage money comes. All of us here in town that are early stage investors, we get regularly smiled and dialed by the big funds that are on both coasts because they're looking to put money to work. They're looking for those great companies that they can write $10, $15, $20 million checks into or bigger at the growth stage. And so those firms will find you. You won't have to move. You can build your company in Chicago, in these other geographies that we've talked about, and you'll be wildly successful.
Love it. Wonderful. So talking about money, what do you think about the venture scene here locally?
Yeah, I think the venture scene here is healthier than it's ever been. You play the tape back, like we were saying, in the late 90s, early 2000s, you could count the number of firms on one hand that were here, completely on one hand.
Right.
And now I was joking with someone, you can't swing a dead cat in this town with bumping into either a seed fund or an angel investor.
There's over 100 at this point, at least.
Yeah, at least.
A couple of years ago, there were over 100, so
right.
Maybe over 200 at this point.
Yeah, and so you've got a great, healthy ecosystem here at the earlier stage. We've got those great facilitators like we talked about, as well as the accelerators from Matter, mHub, 1871, and the likes. And so that's the start. And so what we didn't have early stage capital decades ago, now we have tons. I think with what we may be missing now is that we don't have the later stage funds, the growth funds. So I think that's our next opportunity is to build those growthier stage funds that can write bigger B, C checks, maybe big A checks, because we've got lots of early stage. We definitely have some of the preeminent private equity funds here in town. It's just a matter of building that capital stack here as well.
So it's interesting because you said something. You said private equity. We talked about venture. You're big. You are a big venture guy. I think that there's a ton more angel funds that are popping up. I think there's also, in my opinion, more private equity and family office players that are getting into the mix that are trying to facilitate or start a VC fund. It used to be that these people would sort of stay in their lanes.
Right.
Being that with your experience with USAA as the corporate venture fund manager, and then to VC to, the multiple investments that you've had, are you seeing overlap between private equity and family offices and angel and venture as a whole?
Right. So, my experience with leading a venture fund, leading multiple different corporate venture funds, and then consulting to numerous venture funds and corporates on their venture activities. It's an interesting perspective, but I think you hit the nail on the head. The lines have become completely blurred. No one's just doing them. They're doing every other thing that's out there, and the lines have gotten completely blurred. And I don't mind it because anything that supports entrepreneurs and supports innovation, I'm a fan of. However, people need to know what they're doing. So I will selfishly say, if you're a family office or a venture firm, give your money to me and I'll invest it for you around a fund and we'll define something. However, if you're going to invest on your own, either private equity going into venture or family offices going into venture, think about what you're getting into. Understand the expectations of the entrepreneurs, of your co-investors. And then from a financial return, think about it. Right? You need a portfolio of this stuff, this asset class, in order to hit some returns. So to do a one-off deal here or there, I don't think is the right answer. If you're going to go in venture, have a defined approach and thesis and a set-aside funds so you can build 30, 40 companies in it to hit the return profiles that you're looking for. And then also understand that if you're going to be successful, you've got to be active. If you're just going to be passive, you're probably not going to get access to the right deals, nor are you going to get the returns you're looking for. So you're going to have to be active. You're going to have to be committed to it and have a defined fund around it.
Interesting. So being active, taking a personal involvement, personal role in the investment, right? Just as opposed to being passive.
Right.
Guess,
it's supposed to be like a club deal. Oh, I'm a family office and therefore I have access. Maybe.
Yeah.
Most entrepreneurs are still probably going to look to venture funds for their funding, or angel funds, or Republic, or Angel List, or those types of things before the family offices. So the family offices are creating their own venture funds. I think that's great. And some of them are being more active as well and want to do, either sidecar funds with their fund of funds or things like that.
Yeah. I think it's super interesting. Again, a lot of this stuff didn't exist 10 years ago. And it's like, it's okay. If it's more of an influx in capital for the entire ecosystem, I suppose it's a good thing.
Yeah. Just know what you're getting into, right? It's like venture is ugly. It's rough. It's not like, oh, I put my money in and then I get a 15X in a couple of years. I mean, it's a grind, it's a hustle, and it gets really messy at times. So just have to be prepared for that.
Agreed. Have you ever co-invested with like corporate VCs or PEs or family? I mean, how often does that happen?
So I've co-invested and led rounds with multiple corporate venture houses across financial services, across the energy sector as well. And it's great. I mean, when corporate venture is done right, in that, when I say done right, it means you invest and then you also provide integration with the corporation, whether it's commercial arrangements or data, or the strategic value has to be derived not just for the corporation, but for that startup. And so I like co-investing with corporates. I like working with corporates and I like working with ones that understand what venture is about. It's about building great companies, and it's about, you work for those entrepreneurs. So they have to understand it's just not about doing the deal. It's about creating value. The easy part is putting the money in. The hard part is getting money out, and that's where the work starts.
Right.
So if you're going to be a family office, you're going to be a corporate, you've got to understand that and get in there and do the work.
So along those same lines, co-investing, sort of the same lines, but what about signaling? What's your opinion of signaling? Is sort of perception the reality?
So we should unpack that a bit about signaling risk. So signaling, there's different types of signaling risk that's out there. So the most common signaling risk being that you have a big late stage fund or growth fund that invests in your seed round, or they have their own defined seed fund. Now, when those funds come into your seed and then choose not to participate in your later rounds, that is meaningful signaling risk, because the reality is their job is to make money. And if they don't think they're going to make money with you, that's why they're not putting it in. So they're signaling to the rest of the community that, oh, by the way, yeah, I did it with our scout fund, or I did it with our own seed program, but we're not doing the A. That is pretty hard signaling risk. And people try to message around it, but the reality is it's their job to make money, and they're not putting money in.
Yeah.
Right. And so that's difficult. And I think that's the result of people just trying to dip their toe in the water and think they want to do seed earlier stage, or think they want access, but understand that's really not about access. Right? It's about building relationships and building companies. So I think that gets hard. And that's why I think a lot of these seed funds and scout funds have gone by the wayside, or they've tried to cover them up. Oh, we're not a scout fund, but I have one LP and it's such and such West Coast company, or West Coast firm. So, that's real, and entrepreneurs need to realize that. On the other side of it, there's certain people always say there's signaling risk with maybe someone like myself coming in as an advisor or board member without investing. I think the reality, and most people that know me and that I talk to about this, is there's really no signaling risk, because people understand I have money as part of a fund just like anybody else. But the one thing I have that I can't make more of or do more of is my time. So if I choose to spend time with a company, there's their advisor on that board, that generally speaks more to than if I actually put up funds money in.
Agreed.
Right. So it's just different types of things. And I think you really have to understand that when you're taking money at the earlier stages.
And you've been a big supporter of entrepreneurship, but also a lot of these emerging growth companies. And to your point, I mean, you do sit on a lot of boards.
Right.
And I think you have a lot of experience here. If I'm an early stage startup or emerging growth company getting ready to take venture money, it's a very real thing that I'm going to have to consider board seats, right? And someone who's going to be coming into my business, looking at things hopefully objectively, and looking at KPIs, holding board meetings. I mean, it takes things to a whole nother level for a lot of these early stage companies that maybe have not had the experience of a formal board or even advisory board at that. So I'd like to get into this a little bit more. I mean, what sort of advice do you have for these early stage companies? Because I think it's a very, they need to go about it in a very careful process, right? To make sure that they're sort of getting in bed with the right people to start. But also, when they take that venture money, any advice that you have, or, the formal process, I guess.
There's the fundraising process and there's the board process. So let's talk about the board for a while. So we'll start macro, and then we'll kind of drill in a little bit more on some best practices. At the end of the day, when you're bringing someone on your board, you've got to think about it that it's going to be a minimum 10-year relationship. So is this the type of person, guy or gal, that you're going to want to be with for the next 10 years? And so while I also give people advice that boards do change over time, your earliest investors, seed, Series A investors, tend to come off the board later in life when you're at the DEF side of things, as a general rule, but they're still going to be involved in your company. So understand that. But when you're taking on board members or bringing board members on, realize that you're actually developing a new team, and so try to recruit.
That's a great way to put it.
Yeah. It's a team, and so what makes teams great? Different perspectives, different skill sets, both from background and diversity, but as well as their experience set. So bring people around you on your team that can help you be a better version of who you are, because boards do not run companies. I have this discussion all the time, right? Boards don't run companies. Management runs the companies. As a board member, I can give you advice and direction and my experience that I've seen through working with dozens and dozens of companies and hundreds of millions of dollars of investments. And I could tell you, here's the decision I see. Here's the 3 or 4 factors I think you need to take into account. And I weight each of these factors accordingly, one more important than the other. But at the end of the day, you've got to make that decision. You as the CEO, you as the management team, you've got to own it, and you've got to make those decisions. Now, granted, there are those corner cases where some people are doing things that are so just blatantly wrong that you just got to throw the flag and say, that's it. No, you can't do that. But that such doesn't necessarily happen. That's really the super corner case. But my role on the board is just to be there for advice, direction, experience, little bit of governance, and then making sure the company's on its right path.
Yeah, I think that speaks to your credibility, in my opinion, in what you said. The board doesn't run the company; management runs the company. I've seen more often than not board members that think that they run the company,
Right.
And as you mentioned, I mean, governance wise, sometimes they need to step in and get involved, but it's
But I think to that extent, like you need to keep your board on the smaller side. I like smaller boards versus larger boards because then everyone gets an opportunity to dig in and do their work. And your board meeting really shouldn't be about the meeting. The meeting's just kind of like the forcing function. You need to actively engage with your board members before, during, and after their board meetings. Like your board meeting shouldn't be you reading the board deck to the board members. To me, that's the definition of a bad board and bad board meeting. Like if you have board members that can't read, you got a problem, right? And if they can't take the time to read and come in prepared, that's a problem. So look at your board members as to the role or function, what they're bringing to the table, and then look at your board meetings at kind of an annual basis. Like what do you want to talk about at each time of the year that's most appropriate for your business? What's the administrative stuff you got to get out of the way? What's the KPIs? You got to do a quick review if something's going above or below. What's the big section you want to dig in on? And then what are you looking for help on?
Yeah. So have an agenda, know your stuff, regularly scheduled, communicate often.
Get your board decks out early. Get them out. I like to see them 4 or 5 days before the meeting, business days before the meeting.
Excellent. Great
Then
point.
have a call with your board member before to review the packet. Because you don't want to be reviewing the board packet at the board meeting, right? You've got a business to build. Your board member should have important things to do as well. So make use of that time. Like get them that deck early, go through it, say, hey, you got the deck. What did you see? What do you like? What do you didn't like? What concerns do you have? And then run it from there.
I think it's also important to note for those that don't know the difference between a formal board and an advisory board, both of which you sit on.
Right.
Can you go into a little bit more detail on both of those?
Yeah. So if you're going to do an advisory board, make sure that advisory board works. I absolutely hate vanity advisory boards, like people who you just put their credentials on their website and you claim that they do things and you realize there's absolutely no way they are.
Did you coin that phrase? I don't think I've heard that phrase. That's awesome. A vanity board.
Yeah, a vanity board. It's just trying to take some credentials thrown up there to bolster up your business.
Just name dropping.
Yeah, okay. Exactly. And just stay away from that. You look bad. It just reeks of like, oh, I couldn't build my company on my own, so let me try to tack onto things. And if you're going to have people of significant credentials on your advisory board, just make sure they're doing the work. Like have a scheduled time with them once a week. Come with that agenda once a week as to things you need your help on. And hopefully their help is different than the help you get from your direct board members. Maybe it's more of a counselor type of approach where you're just helping them understand whether it's HR issues or leadership development issues, personal development issues, but whatever it is, decide for your advisor what particular value added role they're going to take. And then make sure that you've got the right incentives aligned.
Yeah. And then the formal board.
Formal boards that generally for your people that were your investors or your independent board members as you get later on in the company's lifespan.
Do you have any advice for people, like what moves the needle to say, yes, you get a board seat versus no?
So the board seat should be, so we're talking the context of venture-backed companies. So generally who's ever leading the round gets the board seat. Who's ever writing the biggest check, they've got most at risk and they have the most incentive to be there and actively engaged. Now, some people don't want board seats and prefer to be passive. That's a different strategy. But when it comes to boards, think about every round that you do is probably a new board member coming on. And then later in life, some earlier members probably start coming off.
So changing subjects a little bit about technologies. You've seen a lot of different industries that you've been involved with and invested in. What technologies are you most excited about today, and why?
The technologies that I'm most excited about are those ones I think can just move the needle for an entire industry sector, if not the world. So the ones that I'm excited about have to do with really powering the software, powering the computers that are out there. And I think going back to Chicago as well, what we have or what I'm seeing in quantum computing now is absolutely mind-blowing. So if you think about the fundamentals of a computer can compute quickly because it's got a bit that can go 0 and 1. Quantum computing, that bit can go both 0 and 1, therefore exponentially increasing the capability of that computer. So anything that gives us that amount of horsepower, and then you take that horsepower and run true machine learning algorithms with a supercomputer or artificial intelligence simulations with a supercomputer, I think those are the things that absolutely become life-changing to industries across the globe. I'm spending a lot of time right now in the power and utility sector because of the same things that's happening there that we saw in financial services, right? Highly regulated industry, facing a lot of disruption, different consumer demands, new technology and business models popping up all over, and they're reevaluating what do they do? How do they compete? How do they leverage technology and innovation? What's really going on out there? And one of those ones is machine learning, artificial intelligence, as well as this potential for the true supercomputer and quantum computing.
Yeah, it's interesting. I guess when robots take over, right? I think they sort of already have, right, with the things that are going on in the background. Google and Alexa listening to us right now, right?
I'm sure. So hopefully we've got the right people with the right ethics running the right companies to understand that the technology is there as an enabler and not as much of a disruptor, but to enable companies and human beings and industries to be better at what they really do.
Yeah. So you talk about some of the things you're excited about. I mean, I think a lot's happened in the VC space and is continuing to happen. We just talked about the ecosystem and how much it's evolved even in the last 10 years. Where do you see the future of venture capital? Is this is there more technologies? Are people replaced by robots with AI and ML? And what do you see as the future of venture as a whole?
I think we're at just this completely anomalous time right now within venture because there's so much money in the system and such enormous funds. Like people never thought there'd be $100 billion funds doing venture or, $500 million seed funds that are out there. So because of that, we've had this absolute flipping of the model. So valuations have gotten so incredibly out of whack when you look at historical returns that it's causing a lot of issues within the system. Like we've gotten this influx of new Series A funds that have come in, if you look at the number of funds across the venture ecosystem and later stage funds, but there hasn't been any of these new funds that have come in the middle. So because of that, you're getting all these companies funded at these huge valuations at the C and the A. They're going to their B and C, and that market hasn't gotten bigger, right? And so I think we're going to see a lot of reckoning that's going to happen. We're going to see some havoc, but I don't mind that because that's where opportunity is. So we're going to see the entrepreneurs that really have what it takes to stick it out and the investors that really believe in investing, and it's just not this tourist thing for them.
So I think that's interesting too, because I think everybody has their different definitions of A, B, C rounds. Mm-hmm. You said it's sort of missing in the middle in that BC area. What does that mean to you? What is the BC to you? And how can we get better at that here in the Midwest?
Yeah, I think those Bs and Cs, those are companies that have already made product market fit. I've already established product market fit, and now it's really down to execution. So the risk on those deals is more in the execution risk. Market risk has been pretty much de-risked if you've got product market fit. So it's kind of an execution risk and then kind of the later stage of market dynamics of how they're going to handle competition, price compression, and then develop that next series of products and services to enable them to become $1 billion business. And those are really hard deals to do, right? And you're running bigger checks, you're looking at rounds. There's always the anomalies, right? But you're looking at rounds that are $20, $50 million rounds. So it's a different range.
Interesting. You've been in venture a while. What are some of the things? I mean, for our listeners, I think they're going, how do I get a hold of Vic to have him write me a check? Right? Is this a valid idea? Am I ready? What are some of the things that move the needle for you to consider writing a check? Or, 2, 3, 4 things.
So for me, it's all about the team. This is all about people. This is a people business, and it's the team that gets it done. Like I don't care what we think the market's going to do in the next 3 years. I don't care what we think the technology direction is. If anything's true, we're wrong, right? And the only thing that gets it through and builds these great businesses are those management teams and are those founding teams. So, to me, success is all about the team. And is that team strong enough, inspiring enough to bring other team members onto the team, and get customers. If they have that, they can make it through. To me, the answer is never in the numbers. If the answer is in the numbers, I'd hire spreadsheets and not people, right? Yes, things have to pencil out with CAC to LTV and unit economics. I'm not displaying that. But at the end of the day, the great successes tend not to be in the numbers, right? It's in the people that do the amazing things. So for me, it's always about team. And it's going to be team I spend a lot of time with, team I've gotten to know, and team I'm going to trust to go on this great war with. So team. Also, the second thing, I want that team to be able to identify for me and articulate for me, what is their unfair competitive advantage? Because the other thing that's for sure is that I don't know what's going to happen is that if it's a great idea, other people will try to do it, right? Yeah. If it's worth doing, someone's going to compete against you. So why is this team going to win more than every other team that comes in the space? Is it their business development? Is there technology? Is it their channel partnerships? Is it intellectual property? What is it that's going to say network effects? Who knows? What is it that's going to make this team win before and ahead of every other team that's out there? So team, unfair advantage. Market, I'm looking to the market, but great teams can create markets and expand markets. So it's a factor, but not huge. And then the technology, how good is it? How innovative is it? Does it, pass the general table stakes of what technology means to that industry? And those are the things. But at the end of the day, it's about the team.
Yeah. Well, and the unfair competitive advantage is also really interesting too, because a lot of people think, I think, IP is, here's my idea, right? And don't copy it, right? And it's not about that at all. It's really about the execution 98.9% of the time.
Exactly.
Right?
Most, like, you've got some of the high science stuff that's going on with quantum computing, what Argonne Labs and Fermi Labs is doing. But at the end of the day, even with patents and intellectual property protections, people design around things. People can not hold up to their intellectual property obligations that are out there and violate patents. And that just means you've got a long, expensive lawsuit on your hands. So it's really about the people and the execution and the people that do the execution. And that's what gets it done. Like, yes, develop your trade secrets, develop your intellectual property portfolio and your war chests. But at the end of the day, it's the people that get it done.
Yep. Agreed. So, I want to thank you again for being a part of this. I always like to ask a fun question to end with. I know you have a very diverse background, not just an investing guy. What's a fun fact about you that people might not be able to find online?
I think the fun fact that you can no longer find online is that I kicked Barack Obama in the head.
Oh, okay.
Back here in Chicago, I used to teach a martial arts class here. And Barack, when he was the state senator, was one of my students. Oh. And so my favorite way to teach people how to keep their hands up was to casually kick them on the side of the head, because that usually gets everyone's attention. So I guess I'm one of the few people that kicked Barack Obama in the head and lived to tell about it. And
without getting taken out?
Yeah, without getting taken out.
Secret Service?
Right.
Did Secret Service follow him around?
This was before he was doing his presidential thing.
Okay.
So this was early when he was just, the state rep.
Yeah.
For us.
That's a benefit to being a Chicagoan, right? We get to see these people all over the place.
That's right.
Yeah. Well, hey, thank you again so much for being a part of this. Very much appreciate and sharing your knowledge with the audience. So
it was great being here. I really appreciate the opportunity, and best of luck with everything you do with Fun Conference.
Awesome. Thanks, Vic. You're listening to The Ecosystem, where we talk with the world's most exceptional entrepreneurs, investors, and emerging growth companies who are all making a difference in the world. This is your host, RJ Pahora, with our special guest today, Vic Pascucci. For more information, go to fundecosystem.com. Thanks for listening, and until next time, folks.